Okay, good morning, everybody. Welcome. We're going to start with a roll call for the September 30th Finance Audit Committee meeting. Amy?
Okay, do we have Jerry Abrahams?
Present.
Tim Hodges?
Here.
Kathy McKinnon?
Here.
George Perez?
Here.
Franklin Perry?
Present.
Sarah Sanders?
Here.
And Gwendolyn Fames. Okay, well, we do have a quorum.
Excellent. Looks like we have several reports today. No real action items except for the minutes. So we'll move to Hazim and Morgan Stanley.
Yes, good morning, everybody. This morning, we just would like to provide a recap of the pricing that we did for the 2021 Series D single family bond issue. Here with us this morning is Jeff Prue from Morgan Stanley. Suffice to say that the pricing in terms of timing went well compared to if we had priced essentially this week or earlier this week. This financing is set to close next week on Tuesday, October 5. So I did provide a quick memo or a recap summary of what transpired, but I will hand it off to Jeff, who's going to do a deeper dive. So Jeff, take it away.
Great, thanks Hazim, and good morning everyone. It's nice to be here with you all today, and along with me I've got some other members of the Connecticut Housing team from Morgan Stanley. Grace Chinema, Cabry Haynes, and Alex Lamas are all on the call too along with me, and as always, we love working with you all, and we're very happy that things worked out great on this transaction. And the transaction itself, we have a pricing book that was distributed to you all, and essentially what we had is a 161,390,000 bond issue broken out into two series. Series D1 was 158 million. That was the bulk of the transaction, obviously, with serials, terms, and a PAC bond. And then we had a small set of AMT serials at the front of the curve, and that was 2.5 million. The proceeds are being used for 100 million of new production for the authority's continuation of its excellent program for first-time home buyers in the state, and also included a $73 million economic refunding, which is subject to optional redemption from 2012. And as always, the authority proactively mines opportunities to subsidize its lending rate through refunding such as this. All of the bonds were set up as social bonds, and that also included the refunding. We looked at how the F2 2012 F2 bonds were used and recommended that we include social bonds on both the refunding and the new money piece, which worked out well here. Highlights of the transaction, really, there were a number of them. First and foremost, I think, was
Jeff.
Yes, Hazim.
Yeah, no, I'm just going to ask Lorraine. Sorry to interrupt. Lorraine, push it forward to the
Yes,
summary
please.
page.
Let's go to page 4, Lorraine. And I will keep talking here while those are coming up, because I can do it without the aid of the slide, but the slide is super helpful, and I do want to point to a couple of the slides in the book to really represent what happened in the transaction. But as I was mentioning, the timing here was a little bit different than what we usually do. And going into the sale, we talked with Hazim and with Bob and really sat down and plotted out September. This year, it was unusual in that the Jewish holidays came early. So we really wanted to look to avoid the the Jewish holiday that was set up for September 15th and 16th. That left for a limited window the week of the 13th, and that's when we really needed to price that week. And then doing a little bit of a deeper dive, we looked into the economic indicators coming out that week. And as you know, the economic indicators in the current market are very meaningful versus last year at this time. I think that we wouldn't necessarily have been as concerned with the release of CPI and retail sales the week of the 13th. But economic indicators this year have caused for a fair amount of volatility in the market. And that is the type of volatility that we generally see in and around a Fed meeting. So we really felt like it would be prudent and to discuss with the authority looking at a pricing on Monday. That would get us out ahead of the CPI release that was scheduled for 8:30 a.m. on Tuesday of that week. And we went back and forth on it, and Lamont and Hazim really were focused in on how we would be able to do this. And if we did set it up for a Monday pricing, would we have everything that we needed to really succeed here? And what we decided to do in consultation with our underwriting desk and sales and trading was we looked at the prior week and decided to get together and do price views on Thursday, release a scale to the market of price ideas so that the retail folks could be working on it all day on Friday and also Thursday evening as well, and then get into the market early on Monday morning, the 13th. And as mentioned, this was somewhat of a unconventional pricing schedule. During the summer months, we would never want to go into the market on a Monday like that, just because a lot of the retail brokers aren't around, holidays, all those things. After Labor Day, we felt like everybody would be around, and with the appropriate level of pre-marketing, we would have everybody lined up for the sale. And what was really nice is when we got into the market on Monday morning, we saw strong retail, and then we saw strong institutional demand as well. The other point that I wanted to make here, there were two others. One is on structure, which was a little different. And when I went through the amounts of the transaction versus the amount of proceeds, there are a fair amount of premium bonds, and that's composed of premium serials and a premium pack. A little bit different from the authority's usual type of structure in that we had a total of 84 million of premium bonds. So that generated a fair amount of premium, and that's what the difference is between the par amount of the bonds at 161 and the total proceeds at 173 million. The structure here also was something that the authority was very proactive on based upon what had been happening in the market recently on other housing sales. As you know, rates here that we achieved were very low, and rates have been very low for a while. And as a result of that, there has been some fatigue for par serial bonds in the market. And so working together, we really took a fine focus on including premium serials first, and then maximizing the total amount of premium serials that could be executed in the transaction. That worked out very well. The subscription levels on the premium serial bonds were up to 5 times, and that allowed us to lower yields twice on some of these bonds, and that was as a result of the 50-50 rule that we used in the transaction on all of the bonds. So after retail, we were able to reduce the yields on the premium serials, and then after institutional again for as much as 5 basis points reduction in yields. So that was another highlight of the transaction. And then finally, and the most important one really is how it was received in the marketplace. And with that, I will turn, Lorraine, please, to slide 9. And it doesn't seem like we're able to share here because I'm not seeing the slides, Hazim. Are they up or not?
I see him.
Oh, you do? Good. I don't need to see them because I've got a color copy in front of me. So all good here. So Slide 9 is just getting to my point about the use of the premium serials and the oversubscriptions. The premium serials went out to 2029, and you can see it. It was a total hit in the market. And the reason why we were all focused on this, and the Authority and CFX and Lamont all were keenly focused on including as many as possible, is that with rates as low as they have been, investors are looking for an inflation hedge, and 5% coupons really do that. And that's really what the driver of that success was there. You can then see that as we go further out on the serial range, out to 2031, 32, that there was a little bit of softness in the market there. That's typical of what we've been seeing recently for all HFAs. As a result of this, we had a couple of orders that came in that were very helpful. Morgan Stanley CRA ordered 5.9 million in the par serial range to support some of the pricing there, and also because of the social bond designation that was included on the bonds, including the AMI bands, allows our CRA folks to buy bonds in the single family issues, in addition to what we've done for quite some time on the multifamily side. So very helpful there. And then we underwrote balances of 5.4 million without changing yields to continue the support there. The term bonds, as you can see, were also well received. There was a term in 41 and a term in 36, both 2 times oversubscribed. And the PAC bond, the notable item on the PAC is that the largest buyer of PAC bonds has been out of the market most recently. That's CAPRE. And while they own many PAC bonds of CHFA, they just don't love the yields right at the moment. And the yield on the PAC bond that was achieved here was 88 basis points. So you can kind of understand why there's a little bit of a pushback on that with sub 1% yields for a 4.7 year average life. And but we were able to bring in a number of other buyers to get that achieved at full subscription at 1.2 times. So that overall was a really excellent result and allowed for rates that ranged on the serial premium serials of 12 basis points to 1.95 on the par serials, term bonds of 2 and 230. And again, the yield on the PAC bond was an 88 basis points. So, overall, super good execution. And as Hazim mentioned at the beginning, we certainly are very happy that we are not pricing this week because, treasuries have been a roller coaster, as has been MMD. And we expect that there's going to be a fair amount of volatility going forward. The last thing that I just want to point out here is on slide 13. And this speaks to the overall reception that we received in the marketplace. This page shows the institutional investors that participated in the sale. And as you can see, it's a very long list. This speaks very well about the credit of the Authority, the credit of Connecticut, what the market views that the Authority is doing in terms of its overall financial management and the management of its parity indenture. So we love to see this because the more folks that are in the transaction, that means that it's all been approved credits. One point that we will also focus on here is that the funds were in the transaction and in a pretty heavy way. The one that I'll just call out is Fidelity, who placed orders across the curve, including for the PAC bonds, for a total order amount of 74 million. That's great news because some of the funds had been sitting on the sidelines for housing issuers because rates were so low. So it's really good to see them back in force. So with that, I will just open it up for questions after just saying thank you very much for the business. We've all of us on our team really appreciate it.
Jeff, I have a question. I was always under the impression that housing bonds tend to sell at par because of the extraordinary redemption, that investors don't want to pay the premium and then get taken out. But has that changed?
That is an excellent question, and you're 100% right about that, Sarah. In this deal and in deals generally, when we do premium bonds, we can do them on PAC bonds and not suffer any penalty because of the overall structure and the contracted calls that we sell to the marketplace. On the premium bonds, the premium serials can be done either as a total lockout from all of the calls, and that's the way that we like to do it, because as you're mentioning, the buyers don't really want to pay a premium if they think that they may get called out. In the case of this transaction, it's a little bit different. We had sold bonds for mass housing the week prior and sold premium serials with complete lockouts from calls. For our transaction for CHFA, we weren't able to do that in total, and it's because of the large refunding component that was incorporated into the deal. So 100 million of new money proceeds, 73 million of refunding. What that does is it really skews the 10-year rule calls, and it means that a large percentage of the overall proceeds must be used for tax purposes in the event that bonds that you do receive prepayments. So what we did is we tweaked the language to say that the premium serials are subject to special redemption from prepayment, but only to the extent that no other bonds in series were outstanding. So we're telling the market we're going to call these bonds only for tax purposes and only if there are no other bonds outstanding. And so the reception in the market for that, because when the investors looked at the overall structure, they said, because of these two factors, we don't really think that they're actually going to need to call. We understand that there's a tax reason, but it's highly unlikely that we'll need to get there. So that allowed us to get that kind of reception in the market, even though we didn't have a complete lockout. But great question.
Questions for Jeff? Okay, I think we can move on to the financial report with Allison Murphy.
Good morning, all. Before you are the August financial reports. Mortgage loan and investment interest revenue are coming in 11.6 million below budget for the first 8 months of the year and 9.6 million lower than prior year. The year-over-year revenue variances continue to be mainly driven by the net reduction of the authority's program assets. In addition, short-term interest rates are down from prior year. The average stiff rate is about 90% lower for the first 8 months of this year compared to the same 8 months of last year. The authority has reallocated some funds that were invested in stiff to higher yield securities. Additionally, fees and other income are 7.2 million over budget through the end of August, and then the main driver for these this variance has not changed from what was previously mentioned. On the expense side, bond interest expense is below budget by 20.1 million and 18.1 million lower than prior year. As mentioned in previous months, the authority has issued more refunding bonds than long bonds, which has lowered our interest rates and costs. In addition, in March and in August, the authority has made a total of 289 million in special and optional redemptions. Many of these were originally purchased at premiums. So the redemptions resulted in the acceleration of these premiums of approximately 7.4 million, which has accounted for some of that year-over-year revenue variance in that line item. Administrative expenses are coming in 4.9 million under budget and 642,000 higher than prior year. When you exclude salaries and benefits of 16.7 million, the current year-to-date expenses are 364,000 higher than prior year's admin expenses. And lastly, the change in net position is above target by 22.7 million. Are there any questions?
There's no questions. We'll go on the delinquency and forbearance report from John Chilson.
Good morning. I'm sorry. Madam Chair,
Yes.
I'm sorry. So back to,
Oh, sorry.
before we go to, I just have one question. Back to delinquencies. We had implemented, I know the answer, but I'll ask it anyway, but we had implemented a series of steps to sort of address the shortfall in production. I understand that, production shortfalls are a function of the market, and I assume that we're really not seeing, Hazim seeing much change in overall production, and that the steps that we took, while incrementally helpful, haven't been materially helpful.
It has been helpful from the standpoint of we believe we have reached a floor. So we are seeing reservation continue to remain steady, even as we are now approaching October. So generally, as you know, when it comes to mortgage purchase, it's very cyclical. So as you get closer to the later parts of the year, reservation will slow down. But what we are seeing is, we're not seeing that drop off. It seems like we have been able to retain the same amount of reservation interest in our program. So that actually tells us something, that now that, like what Jeff was mentioning, this volatility that's happening in the marketplace, we think that as there is this shock within the rate, the demand for our product will become more apparent. So yes, we are not seeing what we thought we would hope to see when we made all those changes. But in terms of, are we going through a free fall, or like, are we losing a lot more? I would say that we are now seeing at least some leveling off. And this, we hope what will happen between now and year end is it's either going to level off, or it actually may pick up, because all of a sudden our brand can distinguish itself in terms of what's available for first-time home buyer.
Right, when rates are higher.
Correct.
And there's more rate shock. Yeah. Okay.
Yep.
That's helpful. Thank you.
Okay. For the month of August, the authority purchased 133 loans totaling $28 million, of which 113 loans totaling $23.7 million were securitized, or 85% of production. The remaining 20 loans totaling $4.5 million were whole loans. The average loan size was $212,000. The August month-end mortgage-backed security balance was $2.2 billion, a decrease of $17 million over the prior month, while our whole loan portfolio declined by 145 loans, or $18 million, with a portfolio balance as of the end of July at $1.3 billion. The overall delinquency rate month over month decreased by 12 basis points to 2.99%. The carrying balance of loans in foreclosure year over year declined by $2.8 million to $34 million, while the number of loans in foreclosure decreased by 23. And for the month of August, the authority also funded 28 down payment assistance loans totaling $1.37 million, with an average loan size of $14,000. 74% of our August borrowers took advantage of the down payment assistance program. With regard to loans in forbearance, we had 285 loans at the end of July in forbearance, which meant or equated to $207,000 of monthly P&I on a principal balance of $34 million. That's just about 2.3% of our overall single-family whole loan portfolio. The 17.5% of those borrowers, however, did make a payment in the month of July. And for the month of August, our loans of forbearance declined by another 10 loans to 285 loans. For multifamily, we closed 2 new loans for them in August. The total number of loans decreased by 1 loan to 255, and our overall portfolio balance is at $1.3 billion. Our permanent loans and construction loans delinquencies didn't change from the prior month. 8 permanent loans in delinquent and 1 construction loan is delinquent. We have 1 loan in forbearance. It's a small loan with a principal balance of under $200,000. Any questions?
Hi, this is Kathy. you know, you hear all these stories about these sort of bidding wars, you know, for houses. Is there any concern that this might crash and, you know, people that have purchased homes at inflated prices will be upside down again equity wise?
That's a good question. I don't know that how much of exposure we have, and with our particular marketplace as first-time home buyers, because the pricing valuations are so much lower. So there's less room for inflation. So I think our exposure to that would be, in terms of the full scale of real estate transactions, our risk would be on the low one, I would assume. Again, just because of the margin of error is much smaller on a low balance loan.
I was talking with some people who pointed out that so many of the winning bidders are cash buyers that aren't even leveraged. So maybe some rich people will be upside down, but maybe not our target market.
Sure. I think
Yeah,
I noticed too that I think the average loan hasn't really gone up. I think it looks like it's only, I think it was in the 190s, you know, last year. So
That's right. The last couple of years, I would say it's maybe 15 or 20,000.
Yeah.
Not quite. Yeah.
Any other questions for John? Azim, do you want to go to the approval of the minutes or to your presentation next?
It will go to the approval of the minutes because my presentation is not part of the consent agenda.
Okay, good. May I have a motion to approve the minutes of July 29th?
I'll move.
Second,
Second.
we'll take a roll call.
Jerry Abrahams,
Aye.
Tim Hodges,
Aye.
Kathy McKinnon,
Aye.
George Perez,
Yes.
Franklin Perry,
Yes.
Sarah Sanders,
Aye.
Glenn Thames.
Yes.
It's unanimous.
Okay. Presentation.
Okay. Here is my presentation, or actually it's more of an outline in terms of how we approach single family loans versus mortgage-backed securities. So this is a request from Commissioner Perez to get a bit more color in terms of how we look at our collateral. So feel free to jump in, because when I prepared the slides, I was trying to make it at a very high level to make sure that you have the 30,000 foot view, and then we can definitely dive in. So let's start off first with the fact that we have a loan pipeline and we have a bond deal. We just talked about the 2021 Series D transaction, and we just make an assumption that we sold bonds and then we raised 100 million of lendable proceeds. So from the production side, we then will offer a product to potential applicants and ask them to apply. We have the vehicle to market the product, but the way we look at things is we first need to determine whether or not they qualify per our guidelines and requirements. So the first thing is, when we issue taxes and bonds, they need to comply with the IRS requirements. So we have a pool of lenders where we determine them as participating lenders, and we provide them with certain criteria where they have to determine that if somebody applies, the household or the borrower needs to satisfy that IRS income limit. And then if the person qualified the IRS income limit, the person qualified the first-time home buyer, and of course, there's all other caveats that is attached to the IRS requirement, in terms of how we look at a prospective applicant, we would review and underwrite the person's income based on a front end and a back end ratio of 35% and a 45%. That's the ceiling. Of course, you know, if somebody can get a loan below that limit, then that's fine. But that's generally is our limit. So this is our first line of defense to make sure that the person we believe is able to acquire a loan, which is a long-term agreement to purchase a house and stay in the house. Okay, so if say that person satisfy that requirement, then we go to the second line of defense, which is mortgage insurance. Now, this is where you always hear about whether or not a home buyer is able to come up with the necessary equity for down payment. So if the person or the household is able to put 20% down, we'll go to step 3. But I just want to go very quickly about, you know, if the person is unable to get is unable to raise enough equity for the down payment. So our program, we have government insurance or private mortgage insurance that they can elect. So if you go on our website, we call it government insured or non-government insured, but essentially non-government insured is conventional or PMI. So for FHA, they do require a minimum of 3.5%, and for conventional, they do require a minimum of 3%. And then you go from there. I'm not going to touch on our down payment assistance because that in itself is a separate overlay. But the idea here is this is how we go forth in terms of determining what type of protection CHFA would need to ensure that it has some type of insurance buffer. So once we're done with that, then we go to this third level, which is more from a portfolio standpoint. So when I talked about participating lenders, some lenders, when they want to originate or participate in our program, they would inquire and request that any loans that they originate, they would like to retain servicing. So if they will retain servicing, then they are able to do so long as they satisfy our level 2 requirement. Because again, the way we are looking at things is we are issuing bonds. Those bonds is supposed to have Connecticut residents. Those Connecticut residents has to satisfy the IRS code. But then also we want to make sure that whoever that we lend to will be able to stay in the house, and which is important for us to then protect and be able to pay back to bondholders. So you have this flow in terms of how we look at things. So if in an event that the so I spoke about the lenders that do want to retain servicing. After 2008, after the financial crisis, we experienced, and not just we, the country experienced an exodus of lenders exiting the servicing business because many of them got burned because of the mortgages and the amount of foreclosures. So during that whole post-financial crisis, there was the attempt by the federal government to support the housing market. And for HFA, we then also went into that same mindset where we realized for us to access the capital markets, we do need to present to investors that whatever that they're investing in is secured. So since that time, there were an attempt, a strategy to start putting our loans into mortgage-backed securities. So for loans that are not retained by lenders, what we do is we then put those loans into Ginnie Mae if they are government insured, And if they are conventional insurance, we will put them into Fannie Mae or Freddie Mac. And you will hear this term, Ginnie Mae, Fannie Mae, Freddie Mac. They're also synonymous with what's called agency mortgage-backed securities, because out there, mortgage-backed securities can either be agencies or private label. So private label would be corporation that will provide a backstop or provide some type of a different type of an insurance. So for CHFA, we only deal with agency mortgage-backed security. Next page, please. So when we talk about loans and MBS, why do we go down the path of MBS, and why not we just retain for loans? So one of the biggest benefits of mortgage-backed securities is there is this concept of timely payment regardless of loan performance. So what that means is when you put a loan into a security, the repayment from that loan is like clockwork. No matter what happens to that loan, the payment to what you hold is like clockwork. So for example, Ginnie Mae 1, if you put it into a Ginnie Mae 1, they will always pay you on the 15th of every month, no matter what. If you get a Ginnie Mae 2, it will be on the 20th. You get a Fannie Mae is on the 25th. Freddie Gold, you got it on the 20th. And then the reason is because the loan default risk is borne by Ginnie Mae, Fannie, and Freddie. But then they will go after the servicer. So that in itself is a separate business model. But at a high level, this is the most benefit, the biggest benefit of putting loans into MBS. And that's why investors, when they buy a bond or they buy MBS, they don't really look at the issuer anymore. They don't look at the HFA. They don't even look at the loan per se, other than to look at the prepayment speed. But they know if they put $1, they know they're going to get back their $1. The downside of MBS is you have this thing about portfolio insurance fees. So if you go back to the prior page, is when you do something, when you get something from them, of course, there is no free lunch. They are expecting something from you. So there is this insurance that you have to pay to get it. Lorraine, go back to the next page. So just to give you a perspective in terms of like what's out there. So nationally, there's over 8 trillion of agency MBS, both multifamily and single family. I wasn't able to extract single family from that 8 trillion, but assuming if like say, single family home ownership or owner occupied is about 60% of the market, you're talking about close to 5 trillion is just for for home ownership. So for the year to date, there has been 2.5 trillion of agency MBS has been issued. So for CHFA, so this is a breakdown just to show to you, going back to that level 1, level 2, level 3. From the mortgage insurance standpoint, we saw that 63% of our borrowers elected to go with a government insurance, 31 went with a conventional, and then 6, it's not required. So not required falls under the 20% equity down. From a portfolio standpoint, this ties back to John Chilson's presentation. 16% remain as loans, and then 84% was put into securities. And of that 84%, the composition is 66% went into a Ginnie Mae security, 30% went into a Fannie Mae, and 4% into a Freddie Mac. Now, the other thing that I didn't add, and then Sarah did ask me a question about the concept about MBS. One other beauty about MBS is because this market is very liquid, in addition to issuing bonds, in my example of like issuing 100 million of bonds, the idea will be to convert that 100 million of bonds into loans or MBS to pay back the bonds. By putting it into a security that is traded and known out there, we are also able to sell such a security into the secondary market without utilizing a bond. So the benefit of that is you will have less bond issuance costs to manage, because that once you put it into a security, you find a broker dealer, you just then price how much an investor is willing to buy, and then you sell it. And then from there, you will get your premium, because you won't sell it at a discount. That means that you're losing money. But the downside of selling it is you're not able to annuitize that income. So essentially, the model becomes more like a wholesale, like you put loans into a security and then you sell it. So you do need to continuously generate business, just like any mortgage brokers out there, where you rely on business to generate income. So I would say that for CHFA, we look at this as more of another way to finance our first-time home buyer product. We are looking into creating a vehicle to allow us the ability to access that secondary market, but we will also continue to issue bonds. So the goal is to have that flexibility if in any event that we run out of volume cap, which is right now we don't have that issue because of the rising home prices, and we are seeing a drop in production. But if there comes a time where we do need to access the capital markets, we don't need to access it through bond sale. We may actually access it through the TBA market or the secondary market. So I'll be happy to answer. I know Commissioner Perez just raised his hand. So Commissioner, go for it.
Well, first I want to say thank you for putting this together. I don't know if other people find it helpful, but being an accountant and someone that spends a lot of time in this business, I did. But I have a couple questions. The first one is, you stated that for an entity that wants to stay being a servicer, they have to comply with requirement number 2 in one of your slides. You know what I'm talking about?
Yeah, Lorraine, move back to, yes.
Now, what kind of due diligence do we do to make sure they are complying with that?
In terms of making sure, because as they are delivering to us the loans, we actually have a team within the single family department that looks at those loans. So we do have a second overlay of underwriting done within CHFA.
And do we verify any of the information they give us?
Yes.
Because what we find out in the past is, and where the big issues were, is that a lot of entities were point blank lying, and like the biggest one that we found, we actually found emails where, they stated to the market that they had a third-party entity looking at the loans, and anything bad, they were not included in the securities. And then we found emails where the third-party entity was telling the seller that this is a list of bad loans, and then the seller would write back an email saying, don't worry about it. Small part of the portfolio, right?
Right.
And that's okay if it's only one. Well, that's not okay. But if that was only one time, that's one thing, right? But then what it ended up being is, instead of being a small number of the portfolio, it ended up being a big number.
Right.
And some of your big ones, like UBS, RBS, Bank of America, to a lesser extent, I mean, they got themselves into some serious trouble. And the biggest individual fine that we ever issued in the state was as a result of this process. Individual focus only one issue, not the biggest fine ever. you know, the cigarettes and that kind of stuff that was done with multi-states was bigger. So that's why my question about the due diligence and making sure that the information they're giving us is actually accurate and not necessarily relying on stuff that they're giving us. Because I could tell you, we've gone into some mortgage companies and we see the files that they submit when people buy it. And then we see the file that we're not smart enough to shred the original file where we could see pay stubs and other things where they white out things like child support, you know, and other stuff. And then the person buying it was getting a pay stub that didn't show the child support or, so I mean, that's fraud.
Right.
And there's no way to prevent fraud 100%, but there is some due diligence that we can do. And that really was more my concern.
Right. Yeah, no, we do have that overlay. We do check the files. If loans go into a security, that's actually another layer of review done, because the servicer for those, you know, Ginnie Mae, Fannie Mae, and Freddie Mac, if a bad loan is put into that pool, just like when I was explaining that a mortgage-backed security, the beauty of it is timely payment. The way it works is it's not Ginnie Mae, Fannie Mae, or Freddie Mac is the one that's paying that timely payment. It's actually the servicer. So regardless whether or not the servicer gets paid, the servicer is obligated to put up the money and then continue to maintain that schedule. So they have a vested interest to make sure that all that information is correct. And then one of the things that they do is they put all this information into another system. So for example, Fannie Mae and Freddie Mac, they have what the systems call the delegated underwriting or loan processor for Freddie Mac. And in there, they you know, I mean, I'm assuming there's an AI behind that to make sure that all the information makes sense. But yes, that we do have set of eyes within CHFA to look at the backup documentation before we even commit to a loan.
Look, and generally I agree with what you're saying, but in reality, if you saw what happened in 2008, 2010, what I like to call frick and frack, the Ginnie Mae and Freddie and those, they had to be taken over by the government, right? Because they didn't have enough liquidity. They couldn't pay. And that's the only thing that saved us. There are samples of other companies that couldn't pay. AIG, paying wherever, you know, there were companies that went out of business. So in theory, you're right. You know, there's this so-called insurance, but it's no good if it goes bankrupt, right? It's no good if they're not there because they took so many losses that they could not pay. So, and the good news is, hopefully that will never happen again, right? The bad news is it's happened. And when you have a market like you have today, where everybody is tripping over each other, and yes, some people are paying cash, but that's coming from home equities or other sources. So it's not coming from the air, because cash, only Congress creates money from the air. You know, everybody else has to actually earn it or have something to back it up. Only government, in particular the federal government, can simply say, oh yeah, we're going to spend another $1 billion and it doesn't assist, right? So again, I appreciate the analysis. You know, there's a reason why the legislators and the wisdom had someone like me by statute be in this board, is to, you know, be the cautionary person, and that's what I'm doing.
Absolutely. So Commissioner, I'll say you this. Right now, there's a debate in Washington about the debt ceiling. Okay, so if that doesn't pass, what you just said may actually come true, because all this MBS is backed by the federal government.
Right, and the real debate is not about, are we going to create another trillion or 2 trillion or $3 billion that don't assist. The real argument is, are we going to spend money and give it to Israel for a missile defense system, right? And we're going to take care of some other group that we want to take care of. So yes, you know, I also believe in fairy tales, right? And I believe nobody ever breaks the law, right? And I believe that you know, world peace and all that wonderful stuff, you know. But the real debate is not whether or not we're going to ever pay that debt, and how we're going to pay it. is how we can spend more money taking care of some special interest groups, right? And I'm not trying to, and I'm not making a judgment whether that's the right way to spend it or not. My point is, it's really not about the debt that they're arguing about. It's actually who's going to get blamed, and I'll do this if you do this, you know, and nothing of it has to do with responsible financing, in my opinion. And that's enough
So
for me.
so what I will also add, since we did touch on it this morning when Kathy was saying about, like, you know, high home prices, Jerry was asking about all the initiatives that we did. So the goal, the game plan going into calendar year 2020 is to rebuild, replenish the portfolio. And one of the things that we're going to do is we are going to tinker with the down payment assistance program. And as you know, that what we have done since late last year and beginning this year was to expand and provide up to 20,000. We increased the DTI to 45%, and we also eliminated the asset tax and include the availability of closing costs from the down payment. And then finally, we even reduced the rate to 1% just to create the buzz in the market, the ability. But one thing we realized, going back to what Kathy was saying, that the home prices, we think that there's still an opportunity for us to improve and increase the purchasing power of our first-time home buyers. So one of the things that we are envisioning going into 2022 is to provide a deferred payment down payment assistance where the loan will be due upon sale or at maturity. So we're not giving free money, but it's just that we think we have an ability to not need the money until they pay us off or refinance. So it's just another way in terms of just how to solve this conundrum where our qualified first-time homebuyers are being priced out. So I just want to throw it out there because these are the kind of things that we are continuing to look into and trying to ensure that we continue to look at the files. We continue to make sure that these are borrowers that can, in fact, pay their mortgages. We're not trying to throw good money after bad. But then how do we get them into the house if they satisfy all that stuff, but then they're being priced out and there's lack of, you know, inventory.
Hazim, are we taking any steps at all or any preparations at all in the event there's a failure to increase the debt ceiling? I assume the answer is no, but
I would say that because, you know, when this thing happened, if you remember, the first thing when this happened was back in 2008 when S&P downgraded the U.S. government from AAA to, you know, AA plus, AA plus, and then thereafter it's like it's this recurring theme every single time. So we do have steps, mostly on Section 8.
I'm a Democrat and I'm appointed Governor Lamont, so I'll just go there. It's a recurring theme when Republicans, not a recurring thing. It's only a recurring thing when there's a Democratic president, not when there's a Republican president. Just that's the fact.
Okay. So I would say that we recurring theme from a standpoint that this is not new. So I think the most pressing for us is payments for projects, multifamily projects, the Section 8 subsidies. That's always the first one that gets impacted because they require those funds, the part to be funded at HUD, and HUD then can disperse the fund to our project. So that's always the case. I believe, if I'm not mistaken, when the last crisis happened, we essentially suspended certain payments that's due to CHFA. So we actually waived the late fees because we knew that they can't pay because it's not because they don't want to pay, it's just that they don't have the subsidy to pay.
Yep. Yeah, I mean, that's a little separate, right? Because you can see that in we saw that in rescission, but
Right. Yeah, this in terms on the single family side, if there is a shutdown, is going to be a delayed reaction per se. I think if it goes long, there's definitely going to be an impact to the TVA pricing, because then investor will be asking themselves, what actually am I buying if I'm relying on the government to provide the backstop, but then the government is no longer there.
right. And I guess, and Fannie and Freddie aren't affected by government shutdowns directly.
Not directly, but there is that perceived, optics that the assurance is no longer there. Big Brother
Okay.
just went away.
Thank you.
Hopefully none of these things happen.
Yes. Okay.
Any other questions or comments? I did learn, Hazim, that Amy will be accepting a position back at the state, and I just wanted to say good luck to her from all of us. We've enjoyed seeing you and working with you. I worked with her when she was at OPM as well, so I expect our paths may cross again.
Thank you, Sarah. It's been
Yeah, I'm
nice,
going to miss.
everybody.
I'm going to miss Amy.
I won't lie that this language has been a bit of a learning curve, but I feel a lot smarter. So thank you.
Yes, well, we'll miss you and good luck to you.
Thanks, Sarah.
And with that, I'll entertain a motion to adjourn.
Move.
Second,
Second.
all in favor, say aye.
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 Okay, thank you.
Thank
Thanks,
you.
everybody. Good to see you.
Thanks. Bye.